options. So what is an option? Well, an option is a contract between two parties in which the buyer purchases the right but not the obligation to buy or sell a stock at a predetermined price from the option seller within a fixed period of time. So what that means is I'm allowed, or if I buy an option, I'm allowed to buy a specific stock at a specific price before a certain time period. Now, what that's referred to is a contract. So when you buy any type of option, you buy them in contracts, and every contract is at least 100 shares. It's always in a multiple of 100, but anytime that we are talking about options, and I'm talking about, let's say, $5 per share, it means that I am always going to have to buy it in a contract that is at least 100 shares. So a $5 purchase is really a $500 purchase. Anytime that we're talking about options, they always come in a contract of 100, and that's something to be really clear about. The predetermined price that we're going to be talking about is referred to as the strike price. So if I say I want to buy X stock from you in 2 months at $120, that $120 is referred to as the strike price, and that's how you'll buy it in whatever platform you use. And the period of time, let's say it was 2 months like the example I just used, that's referred to as the expiry date. That is when you have to buy those stock before at that given price. So let's dig into it a little bit. The first thing we're going to dive into is the most common type of option, and it's called a call option. What a call option is when you buy it hoping that the stock is going to go up. It means that you're long on the stock or you're bullish on the stock, and so you buy a call option. Now, like again, they're in units of 100, they come with an expiry date, and the great thing about these is that you can buy and sell them just like a stock. So just like you can go in and regularly buy and sell a common share or a stock, you can go in and buy and sell your options up to and including that expiry date, or you can execute on your trade and buy or sell that share whenever you'd like. So that's really something to be really important, is I can go in and buy an option today and I could sell it tomorrow. I could hold it for 1 week, or I could hold it all the way out to the expiry date, and the value of it fluctuates just like a stock. We're going to look at that a little bit closely here in the examples we use though. So the first example is, I'm going to use my mouse here. We've got Apple at today's price of $100. Now I'm making these round numbers so that it's really simple. We'll look at actual Apple contracts here in a minute. But today's price is $100. I'm buying a contract, a call option contract with a strike price of $115. It expires on June 15th. Now, it doesn't really matter. We're gonna say that that's a couple weeks out from now. Like, this is a fictional example, so it doesn't really matter, but let's just say it's 1 to 2 months out from now. So I think the price is gonna go up from $100. I'm buying at a strike price of $115, and that contract, that call contract, cost me $5 per share. So I'm paying $5 per share for the right to buy Apple at $115 before June 15th. Now I'm buying that contract in a unit of 100 shares, so this contract is really going to cost me $500. That $500 is divided by 100 shares. So for this example, I'm going to break it down on a per share basis because it's easiest to compare the benefits of buying the option versus buying the shares, and that's probably the main thing you guys want to figure out right now. So just to summarize, $100 shares today, strike price of $115, call contract costs me $5 per share, and it expires a couple weeks from now. So fast forward a couple weeks from now, it's now June 14th, and we're coming up to your expiry date. You need to decide, do you want to sell the option, do you want to execute the trade, or what do you want to do? So it's June 14th, and now we have a price of $130. Everything looks good. So what I want to point out here is the difference between buying the option and buying the shares, and what the return on your investment looks like and what the risk looks like as well. That's what we're going to really dive into here. So in the event that you had bought the option, this is really exciting. It's June 14th and you have a couple different options. So let's just run through the math on it. You have a sale price here of $130. So you could execute your trade and you could then turn around and sell those shares in the market at $113. If you did that, you would have executed your trade at $115, and that contract would have cost you $5 per share. That would have left you with a profit of $10 per share. 130 minus 115 is what you bought it at, and it cost you $5 to get the right to buy it at 115. So your profit per share was $10. Now here's the really crazy thing here is we're just going to assume that you had some extra money laying around so that if you needed to execute that trade, you could. Otherwise, you just sell your option in the market and you get roughly the same return here. But the math on this is pretty amazing. So your profit was $10 per share. Your upfront cost on it though really was only that cost of the call contract, because you were going to buy the share and sell it right away. So all you needed was some liquidity there to execute the contract. But the actual cost of that contract was only $5 per share, and you made a profit of $10 per share. That gives you an upfront cost of $5 on a return of $10. That gives you an ROI of 200%. You spent $5 and you made 10. And you did it in a contract worth 100 shares, so realistically you made $1,000 on a $500 contract purchase. That's an amazing return, like pretty phenomenal on a couple week changeover here. Now let's look at the math. If instead of buying the option you had bought the shares, well, the sale price was $130, and at the same time Apple's today price up here was $100. So you made a profit of $30 on that transaction. Your upfront cost on that transaction though was $100, because you had to physically buy the shares and outlay that cash and wait on it. You had to wait over that period for the value of the shares to go up. So you laid out $100, you made 30, and your ROI was 30%. That makes sense there. So, but here's the massive difference is you did the exact same share, the price moved the exact same amount, but if you had bought the option, you made 200% return on your money. And if you had bought the shares, you made 30% return on your money on a per share basis. And then you just spent however much money you want. So the option paid off significantly higher here than buying the shares, because the reward on an option is much higher, but so is the risk. And we're going to look at that here shortly. But I do want to point out, if you had bought the option compared to the shares, and this is what happened with the price, you would have done phenomenally well and phenomenally better with the option compared to buying the shares. That's not always the case though. So when we go to our next example here, it's the same math, the exact same system, but now the price on June 14th is $120. So we'll run through the option again. Your sale price is $120, your strike price was $115, and your call contract was $5. So you sold it for $120, but it also cost you $120. You didn't profit anything, but you also didn't make any, and your ROI was $0. You basically executed the trade right at the strike price, and you made enough money to cover the cost of your contract, and you didn't make any money. And now just remember, this price right here on June 14th is only $10 less than the 130 we looked at in the last example, and you lost all of your profit. So you went from 200% to 0% on the option. Now, if you had bought the shares, it's a little bit safer and you still made money. So the sale price, oh, we got I got a little blooper here. The sale price was $120 and your purchase price was $100. Your profit on that is $20 and your upfront cost was $100. That means your ROI was 20%. So in the exact same example where the price was only $10 less, your sale price on June 14th was only $10 less, you made absolutely $0 on the option, and you made 20% by buying the shares. So the risk return is really offsetting. And if we go one more, so this is where the price is $110. So the price, the sale price of that option on June 14th is lower than the strike price of the contract that you had purchased. Well, when we go through the option, things really aren't good. You can't even execute that trade. It's not worth it for you to execute that trade, because you would be buying it at $110 and then selling it, you would be buying it at $115 and then selling it on June 14th at $110. You wouldn't make any money, so you wouldn't even execute this option, and unfortunately you would have paid $500 for this contract, and it would be worth absolutely nothing if that price on June 14th doesn't get above $115. So unfortunately it's not worth basically anything, and you've lost your complete $500. So your return on the investment is a negative $500. Whereas if you had bought the shares for $100 on the same price, the same day, and the price was now $110, you could have sold it for a $10 profit and you would have made a 10% ROI. So buying the shares was much safer, but when you bought the option, you had the upside of making 200, 300, 400%, as long as the shares go up within that certain amount of time. But if they don't go up by very much or they don't hit your specific targets, you have a huge risk of that option being worth absolutely zero. So in summary, the one thing I really want to touch on with options is risk. They're super volatile, but they do have a very high risk return payout. So for instance, if that Apple shares kept going and kept climbing before your expiry date, you would have made a significant amount of money. Now, they have huge risk to them though, and that's the challenge. The other challenge is that they're not always super liquid. You could get a quoted price of $5, and because there isn't much volume on it, you may have to sell at $4.50 or $4.75, whatever the real number is based on how much volume is going in. So whenever you trade options, I always recommend doing it with large companies that have lots of liquidity. The one thing that I do want to touch on though is they're not always super risky. You can even use them to de-risk some of your trades. So for instance, if you were short on a stock and you were short selling a stock and you were thinking that the price was going to go down, you could make a big bet on yourself saying that the price is going to go down and you could short sell that stock. To hedge your risk though, you could buy a call option so that if you were wrong on the short sell, you still made a little bit of money on that call option. So these kind of options can be used to de-risk some of your trades and hedge your portfolio, but only when they're used in the right ways, and you have to really know what you're doing. Also, the one thing I really want to emphasize is that if that sale price does not get to your strike price before the expiry date, your basically option is almost worthless. So you really need to be able to manage that and manage the stress, especially if you're going to be watching this thing every day. It is going to move drastically, and not by a couple of percent, but by 20 or 30%, sometimes every day. So being able to manage that in your mind and in your head and not panic is something that you really need to be comfortable with. Now, before we go, I do just want to pull up and show you what this actually looks like in the real world. So I've got a stock quote. I'm just going to refresh this so that it's live, but I've got a stock quote here for Apple. This is on the NASDAQ, and this is the overview page, what it looks like through my bank. And if you go to options, this is kind of what the quote looks like right now. So Apple is trading at $283 USD. Here are the dates you can choose. You can go all the way across here. Right now we're going to choose a July 17th expiry. One thing you should know is these options usually expire on the third Friday of every single month. So that's usually what the dates are that you'll see here. And if we go down, we can see the strike price in the middle. We can see puts on the right side and calls on the left side. Calls are exactly what I just explained in this video here. Puts are the exact opposite. So they're the short selling side of calls. So instead of thinking the stock is going to go up and you want to get in on that side, puts are the exact opposite. So we're going to go and we're going to look at calls, and right now the strike price or the value of the stock is $283 here. So we're going to go down to 283, and you can see that it's highlighted here. That is basically where the stock is at right now. If we go down, we can see what strike price we want to get in at. So let's say we want to get in at $320 in this July time period. So we're going to buy it for an expiry of July 17th. We're going to buy it at a strike price of $320, and this option right here is going to cost me $6.45 per share. So when I execute this, I'm going to buy it in a contract of 100. You can see down here the multiplier is 100 units, and when I execute this, it's going to cost me $645 plus the trading commission. So let's see where this takes us, and we'll go from there. We'll buy this, boom. So I choose my account. I say that I want to buy to open it. I want one contract of 100 shares. I want to buy the call and not the put. I want to buy Apple on the US market. Expiry date of July 17th. You can choose all the different days right here. A strike price of $330. I'm going to do it at the market price so that it executes, and I want to do it in any part. You hit continue and submit, and then you will have executed your options trade. You can then buy or sell more or less. You can get out of your entire position all the way up to that expiry date, but that price is going to fluctuate all the way up to that expiry date, and hopefully the actual value of that stock is much higher than the quoted strike price on your contract, and then you'll be making some money. So lots more to go. You can dive into this really deep, and you can put together a lot of different trading strategies using options. This is just a super high level course and lesson on what a call option is and a basic understanding of how these options work. So please stay tuned. We got a lot more courses to go.